Hi, Dustin here. Conventional wisdom will teach us that substantial wealth is generated during bear markets by buying when others are fearful. But rarely does anyone explain the science of investing. What is often heard are motherhood statements like, buy the dip. But what happens when the dip keeps on dipping and never recovers? And, you can never time the market. But do you know what to buy even when you aren't trying to time the market? The reason for every investment must be clear-cut. This doesn't mean that we'll never make wrong investments, but instead, every buy and sell decision must be rational and calculated. Market conditions can shift, so it is not uncommon that certain investments should be tweaked to better fit the changing times. There is no I in investing. As investors, when the market shifts, we recalibrate. We throw away ego and the urge to be right out of the window. Having established that investors should be rational and humble, now we must get our facts right, so here are the realities on the ground. The biggest factor that will influence the direction of our markets is the US Fed's decision on interest rates. Initially, markets have priced in the terminal rate, or the level where the rate hikes will pause, to be at 5%, but now, experts have increased their estimates to 5.5% to 6%, which is said to happen mid-2023. Presently, the US benchmark federal funds rate is still 4%, so rates still have room to increase based on those estimates. But it is important to note that the Fed has reported that it recognized that inflation data is a lagging indicator, so the pace of subsequent rate hikes will be carefully adjusted moving forward. Sounds cautiously dovish to me. It is undisputed that the US will fall into a recession. The real uncertainty lies in the start, length, and severity of the recession. The US Fed itself is on the edge, but I don't blame them, especially when market data seemingly contradicts itself. For example, real estate is well known to be highly sensitive to interest rate hikes. But even US real estate reports are giving mixed signals. The most recent home sales report shows that home sales are decreasing, yet the job numbers in the construction sector are still stable. What can further prolong the period of high interest rates is the Russia-Ukraine war. The energy market is in a conundrum as Europe enters its winter season. Energy demand is high, yet supply is scarce. To make matters worse, OPEC has decided to cut 2 million barrels of daily oil production effective this December in anticipation of the impending US recession. Another important country to take note of is China. China's economy still has not gotten out of the woods. The Chinese government still insists on its zero-tolerance policy on COVID. These COVID lockdowns are hurting the Chinese economy. But if and when the Chinese economy will reopen, global food and energy demand will have a huge uptick. What about the Philippines? The Philippine inflation rate clocked at 7.7% in October 2022, which is a 14-year high. The Philippine inflation rate is expected to remain high mainly due to three reasons. First, the peso is seen to further devalue, so imports will become more expensive. Second, the recent typhoons have damaged crops affecting local food production. Third, being a net importer of oil, energy prices will remain high. On the bright side, third-quarter earnings reports are healthy, though these sales reports are coming off a low base. Banks' non-performing loans continue to decrease. Revenge spending and revenge travel is beefing up sales in the mall and hospitality industries. But it is important to note that as interest rates rise further, consumer spending will shift away from discretionary spending. Also, even though higher interest rates are seen to benefit banks, borrowers will shy away from availing of new loans due to the high interest rate environment. With these facts, here are the best ways to grow your money in this bear market according to the experts. First, investors should take advantage of the high interest rate environment by locking in bonds with 5 to 10 years of tenure, but must be careful of the issuer, concentration, and liquidity risks. Second, it is important to remember that equities bottom during a recession, not before a recession starts. Therefore, there is no rush to go all in. Accumulate stocks slowly as inflation has not peaked yet. What stocks to buy? I prefer dividend-paying stocks as we cannot predict how long the recession will last. Stay away from REITs that have high office space rental concentration due to the POGO fiasco that has yet to be resolved. Investors can also find value in dollar earners. Also, stay away from highly leveraged companies, especially the ones with high dollar-denominated debt exposure. Exposure to the bigger banks and high-moat companies is also welcomed. Allocating a small portion of your portfolio to mining stocks, especially ones that produce gold and copper, can serve as a profitable wager, especially when the time comes when the US Fed will cut rates, in effect, weakening the safe haven status of the US dollar, and the reopening play of the Chinese economy wherein precious metal prices are expected to increase. Third, cash is now king. When the market will bottom during the recession, investors with cash on hand can pounce on quality stocks at a steep discount. Invest in growth stocks. This strategy presents the highest potential upside. Last and not least, diversify. As emphasized in my previous video, risk management is extremely important. To be effective investors, we should be risk managers first, and profit seekers second. Thank you for listening. If you found value in the information I shared with you, I would appreciate it if you could press the like button and share this video with your friends and family. Also, if you want to listen to similar videos in the future, do subscribe to this channel. Dustin out.